Welcome to the WangHiro podcast, where we answer Malaysians' burning questions about personal finance with fact-based answers.
As of March 2022, Alibaba had over 900 million customers. And in the same year, its franchises Tmall and Taobao recorded transactions worth $1 trillion. There's no doubt that Alibaba is big business. However, if we look at the share prices, it's actually gone down about 3 times since 2020. While the business is huge, the question we're asking today is, should you invest money in the company behind it? Welcome back to the WangHiro podcast. This is episode 2 of Stock Investing from Zero, a series where we help absolute beginners learn how to analyze stocks from scratch. So John, we need you to put on your beginner's lenses and take a look at Alibaba and tell us what a beginner should be paying attention to when it comes to analyzing this stock.
Thanks, Louis, for picking Alibaba. A company that is very familiar, especially in this region. So I always begin with my 5-question checklist, and I'm going to go through those 5 questions up front. First question is, what does the business do? Second thing is, how do they make money? The third question is, are they profitable and financially stable while doing that? The fourth question is, who is their audience? Who is their customer? And how big can they grow? And the last but not least question, are they cheap or expensive? Now notice, Louis, within those 5 questions, I have not even asked about share price.
That's true, because that is actually the first thing people look at when they buy a stock. And that's surprising that you wouldn't mention it. So let's look at what's more important than that.
Correct. Because 89 renminbi or US dollar, whatever currency that you are talking about, versus another stock 89, it doesn't mean that the 89 US dollars versus the 100 US dollars, the 89 was cheaper. But that warrants another episode altogether. Just focus on these 5. What do they do? What businesses are they in? How do they make money? Are they profitable and financially stable doing that? Who is their audience or clients, and how big can they grow? Last but not least, are they cheap or are they expensive? Okay. So first and foremost, what business are they in? So we know them as, how do we get that kind of information? Most people go in and type Google and what does Alibaba do, right? And then they get bombarded by either a news report, CNN, or Jack Ma as a personality and all that. Where do you think is the best place to look for, Louis?
Company website.
Very good. Company website. Yes. Specifically where in the company website?
Investor relations.
Yes. And what are the raw sources of information that you think will present to you quite a vivid picture of the business, actually? What documents will you be looking for? Annual report, okay. Because of financial disclosure or investing disclosure today, most large companies, Louis, and annual report is usually 200 to 300 pages long, depending lah. The shortest one I've seen is probably less than 100 pages. But the moment you throw a 200-page report to someone who has completely no idea what to look for, right? It is overwhelming, Okay, so here's an expert tip for you. Most big companies, every quarter or every year, they have an investor presentation deck.
Wow, that's interesting.
So the investor presentation deck, it's more colorful. There's a lot of graphs. There's a lot of simplification. There's a lot of bullet points. And you'll be surprised what you can glean off an investor presentation deck, because it's meant to simplify, concise the message. So obviously some smaller companies don't do it, but most of the big companies that I know actually have an investor presentation deck. So if the annual report is a bit too overwhelming, and I know it is for a lot of newbies, the investor presentation deck is usually between 20 to 30. So if you go for a company like TSMC, okay, Taiwan Semiconductor Manufacturing Company, the largest semiconductor wafer manufacturer in the world, they actually report monthly numbers, actually, Louis. That's how transparent they are. Monthly revenue numbers, okay? Obviously, the quarterlies will give you a more detailed one, but For Alibaba, what we do? We're gonna go on. We're going to go on Google and we type Alibaba investor presentation deck. Okay. So you will likely land on the what do you call it? Investor relation website. Okay. And under filings, let me see. Investor tools. Yeah, you will find on Alibaba's website there is actually a deck, right? They even have investor day. So when you have an investor day, definitely you have a deck already. Okay. So usually public listed companies every quarter they will have to make a quarterly announcement. Okay. Now I know the moment you see this, wow, words. Wow, what is this? Adjusted
Fainted already.
EBITDA. It's like, okay, brain shut off straight away. Zoom.
Yeah.
Brain shut off, right? Okay. But where you find the investor deck, you see things like this roadshow, 33 slides.
Oh, amazing.
Yeah. Okay. What are the users like? You already answered question number 2, which is who are the users and how is it growing, right? So you know China has a population of 1.35 billion. So far, online shoppers is this. This is the potential projection, right? So from here, right, you can. I'm not going to read through one by one, but you can go and download this. Obviously, I don't think this is the latest. Yeah, but I think you guys get the gist, lah. Instead of overwhelming yourself with an annual report or quarterly, you have this investor deck. Even tells you how does it work, what is the network effect of the marketplace. You know, who are the retail sellers, who is the wholesaler, and all. It's pretty interesting. You know, when you come from that angle rather than looking at just purely financials, you kind of like, hey, this is the story. This is the story you want to hear, not a story that, hey, this share price is gonna go up 50% by tomorrow. But what's the basis of it? This is the basis.
Correct.
If it goes up, it should be this is the basis. That means they've expanded their business, expanded their reach. Yeah. So yeah, this is definitely an old deck because Jack Ma is still executive chairman, right? Yeah, but you can find the latest deck lah. You just have to be diligent enough to seek it out. Okay. So next question. How do they make money? Usually, what business they are in and how do they make money can be answered within the same vein when you research. In Alibaba's case, I think a good example for you and I would be Lazada, which is their subsidiary in Malaysia and Singapore. A vendor actually places a product placement on the e-commerce website. Alibaba will take a cut of whatever they sell. And then we as consumers go to the mall, which is the Lazada mall, and we buy things. And they either charge vendors just hosting fee or a host of other fees. I know you use Shopify extensively, Louis. So how Shopify makes money and how Alibaba makes money, they each have a niche role, a niche money-making machine to play around with, right? Yeah, so how do they make money? You have to understand the overview of the business and what are the things that they look for. Is it vendor growth? That means they get more and more e-commerce vendors to come in and growing that. And how do they go about doing that? Secondly, is are they actually increasing what we call the take rate? Because certain products they say, hey, I only charge you 2%, or certain it just goes higher and higher, right? Now, I'm not an investor in Alibaba, that's why I don't know the numbers off my head, right? But if you do want to invest, you got to figure out those numbers. You got to research those numbers. Yeah, how do they make money? Yeah, so far so good, Louis.
Yep. So far so good. I loved that the investor day deck.
Yeah.
And yeah, these are the questions. I mean, if you are interested in investing in Alibaba, you have to know your e-commerce figures. You know what's the money making areas for an e-commerce business. Yeah,
Correct.
Quite different for every platform.
Exactly.
And also Alibaba, I would also like to add, you have to consider it. I think they are planning to split the different divisions, but every platform makes money differently. Alibaba makes it differently. Tmall makes it differently.
Correct.
Taobao makes it differently. They charge very, very different commissions. Yeah.
Yes. And you need to understand those numbers, because if you don't understand those numbers, you see what are we trying to do? we're trying to buy a share today in the hope that it's like worth more tomorrow. Why is it worth more tomorrow? It's worth more tomorrow because it has actually grown in terms of sales, profitability, and actually its customer reach. And for us to kind of make a prediction of whether it will get there is to understand these metrics that I talked about. Are the customers coming back or increasing? Are they actually Alibaba taking more out of vendors and all these kind of things, you see? So yeah, unless and until you know those parameters or know how to measure those parameters, then I think whatever you're buying, you're kind of speculating. Yeah, kind of speculating. Okay. So moving on to the third question is, are they profitable or financially stable while doing that? So one of my favorite tools, and I'll leave a link in the description below, is this thing called Ticker. Okay. What does Ticker does? It's a financial data aggregator. What do financial data aggregators mean? So usually numbers for a public listed company is published in an annual report every year, once a year. Okay. And some companies, they do a comparison this year's figure versus last year's figure. So normally you have 2 years of figures in one annual report. But for you to get 10, 15, 20 years kind of financial data, you need a financial data aggregator. So in the previous episode, I actually talked about the free one, which is Yahoo Finance, Financial Times, which is paid, Guru Focus, Coifin, Share Investor. There's plenty of them. I use Morningstar. I subscribe to Morningstar. I subscribe to Ticker. I don't subscribe to Yahoo Finance. The Yahoo Finance also has a premium one. And I used to use Share Investor, but I found Ticker to be more value for money because it's global data. Share Investor only have 6 exchanges, US, Hong Kong, Thailand, I think Philippines, Indonesia, Malaysia, Singapore itself. So not as extensive. Okay, so I'm going to share this Ticker screen with you. Okay, and the reason why I use this quickly is it's so convenient, so fast. So what I do is, the moment I log into Ticker, type in Alibaba, you can see this. Okay. Remember the first question I asked is what business are they in and how do they make money? So other than the investor presentation deck, Ticker actually under company overview will actually have a paragraph to describe the business. So there is another way of getting that question answered.
Is that an analysis from them, or where did they get this from?
Okay, very good question. Bloomberg has it. Most data aggregators has it. Sometimes they get their own content creators to actually glean it off the annual report and synthesize it. Some I know they just take excerpts directly from the annual report without changing anything. Okay, but what I'm guessing here, and I'm not too sure about the answer, this is kind of like written by themselves. Yeah, kind of written by themselves to kind of like, they probably glean it off some analyst report also, and a combination of these factors and put it there. But it's quite accurate, to be honest. And as I mentioned, Louis, in the past episodes as well, never only glean from one source.
But I can see here, like there's so much information
it's
here.
Quite extensive already, actually.
Concise, actually.
Yes, it's concise. At the same time, it's not watered down, too watered down.
Yeah, correct.
What I like about Ticker is that you look at all this, they actually let you know what are future events happening. There is a Beyond Week. Okay, there is a group holdings special call on March 30th. They're presenting at a TechNote Global Beyond Week event. If you can attend that, then they presented the Credit Suisse. This is probably their results briefing, all that kind of thing. So all of it is here, and that's why for me, I feel it saves me so much time of googling here, googling there, and kind of thing. And I have it all in one place. Okay. So the question we try to answer is, are they profitable and financially stable at doing that? So in this case here, you see here 2012 until here 2023. This is actually a timeline drag. So if I want less years, I'll just drag it along. If I want more years, then obviously I drag it all the way to 2012. Okay. So I'll just take the last 5 years. Our last 5 years will be 2018. Okay. And I can actually plot it out on a chart to show you this is the sales. Okay. Did they make a profit? I can plot it out here. They did. And most important for me is whether they made a cash flow. So cash flow from operations is here. So you want to see the numbers? You just click on show label and you can see. Now, what was interesting, I was like poking around last night for this. I also like to look at margins. So if you look at gross margins here, you can plot it up. And net margins will be down here, excluding extraordinary. This is including, this one excluding. You can see the margins are coming down, Louis. I don't know if you notice the purple line and the orange line. They're actually coming down. So I wouldn't go too deep into this, but it's something that you as an investor need to look into, because when margins are coming down, especially gross margins, meaning pricing power is not there. Usually gross margins is a good indication of pricing power, because gross margins is your sales minus your cost of goods sold, which is a direct cost of the product or services that you are building into. Your operating margins are actually net your gross margin, your gross profit minus off your SG&A, salary, general and administration expense, which includes your marketing, logistics, all that kind of thing. So if you want to control salary, all that, it's part of operating margins. If you want to control your cost of your goods, raw materials or services, it's actually your gross margins. And the way you manage that is you actually, if you can price your products or service based on inflation, meaning because the raw materials have increased, you cost pass through, then that's where you maintain your gross margins. But if gross margins are coming down, that means you may not have that kind of pricing power anymore.
Wow, that's an interesting insight.
Yeah. So operating margin.
Looking at a longer timeline is useful for that reason, right?
Correct. Rather than just looking at 1 year, because you want to see how this company performs over time. You see, not just on a one-off. And as you can see, right, the pandemic gave them a boost in sales, but then their profit kind of dropped, I don't know if you notice. 2020, peak of the pandemic, and then 2021, China was still in a lockdown, remember? China just only recently opened up, right? So you would have thought that Alibaba or any e-commerce platform would have thrived during the pandemic, but apparently not. So competition, it doesn't mean that e-commerce is dying. No, it could probably mean very many other factors. Other guys like Pinduoduo, Meituan coming in to take up their market share and things like that. So yeah, it helps if you have what we call a time series of this financial data to help.
Time series.
Time series. The keyword is a time series. Okay, so that's on the finance side. Next question. Who is the audience and how big can they grow? Now, remember the investor deck that I showed you earlier? What you're looking for is you want to know where are they today? Who are the customers today? And how big can they grow? The word that we're looking for, and I mentioned this in Netflix, the series that we did previously, is a total addressable market. So if let's just say China has a population of 1.35 billion users, let's just say, I don't know Alibaba's current active users. It says here as of March, you said as of March, Alibaba had 900 million customers. We don't know how many of them are fully active, how much do they spend.
Yep.
But let's just say they have 900 million customers and the total Chinese population is 1.3 billion, for example. That means the potential to grow if they only stay in China is another 400 million. If you get what I mean? That is their total addressable market for China, right? And that's why they're aggressive in their overseas expansion, buying up Lazada, buying up the other e-commerce platforms outside of China, because they know that, hey, I've almost reached saturation point. Now, why is this important? Is because you want to know, are these companies actually growing? Do they still have room to grow or not? It's like you're putting in a plant, but the ceiling you put in let's say you put a plant in a room, but the ceiling height, you only set it 0.5 meter. But let's just say the plant that you want is a durian tree. Yeah, so you kind of stunted the growth, right? Yeah. So so far so good, Louis? Is that sufficient for you to understand what the meaning of the question?
Yeah. I think we just have to consider what markets they're in, probably.
Yeah.
You know, especially only a few businesses I think can say I have 900 million customers.
Yes.
So
Yeah.
so when we think about, wow, that's already a lot. Can they go bigger than that? Probably.
Correct.
If they go into India, that's my guess. My very layman guess is like the next big market is India, but you know, we
You've
have
got Flipkart, huh? You've
Yeah,
got
Flipkart is there.
Amazon even failed there, you know.
so it's a very hard market to go into, and then the next big one is the States. Can they actually, you know, like conquer that? You know, those are the questions that, I mean, I've been in e-commerce for more than 10 years, so I kind of know this market quite well. So there are some limitations to which markets they can penetrate into, just simply because of where they are from and the competitions in those markets. Yeah, I think it's thing that we can consider in that way. Yeah.
Very, very, very good line of thoughts, Louis. So as you were mentioning that, I'm actually preparing for the next question, which is, are they cheap or expensive? So what does cheap actually mean? And I think for users or audiences who did not watch the previous series that we talked about Netflix, I do need to set up the premise again. You don't compare the price of chicken to Wagyu beef. Wagyu beef got A5, Miyazaki, and all that kind of thing, right? Okay. So a $1 company selling apples cannot be compared to a $1 company selling oranges. It's two completely different things. But there are, in investing, there are certain what I call relative valuation metrics that you can use. Okay. And one of it is this thing called price to earnings. Okay. It's price to earnings. Most people, like what you said, Louis, you go in stock market, hey, what's the share price? $100, $200. $100 means it's nothing. It's there's no tangible metrics to measure whether $100 is cheap or not.
I think how they measure is like how much I can afford. Okay, so this is enough for me to buy with this budget. Okay, so I'll just buy this. Yeah, some people they evaluate the cheap or expensive scale based on that.
Yes. Okay. And this warrants another episode of probably because I have to explain what is market cap, but basically it just means this: the number of shares multiplied by the price of the share is the equivalent of the entire market capitalization of a company. So let's just say you have 1 million shares and one share is $1. The market cap of this company, let's say company A, is ringgit 1 million. Now, can I make the share price cheaper or more expensive? Now, think about it. There's two variables. Number of shares, price of the share equals to a market cap. Okay. Can I make the share price cheaper or more expensive? How do I do that?
Yeah.
Without changing market cap.
Shares, change the number of shares.
Precisely. I just changed the number of shares. So if I want to increase the price, I reduce the number of shares.
Oh, I see.
If I want to reduce the price, I increase the number of shares. Market cap remains the same. You think of it, it's a cake.
Right.
You can sell a $5 slice or you can sell a 50-cent slice. The 50-cent slice, right? It's the $5 slice you divide by 10. So it's cheap already.
Again, a smaller slice, right?
Precisely. So that's why price is meaningless unless you know what is the market cap. Market cap is a better reflection of the price of the company, because you know the number from the number of shares with the market cap, you already know what's the price, vice versa. Yeah. So these three variables: the market cap, number of shares, price of the share. With just two variables, you already know what the other one. You can just subtract one. Yeah. So rather than use that as a measurement for value, cheap or expensive, you actually want to look at there's two. There's one called absolute valuation, which we will reserve that for later, talking about discounted cash flow, and all that. But a relative one is what we call price to earnings. So what is price to earnings? Louis, two coffee shops Coffee shop A selling for 10 million, coffee shop B selling for 10 million. Which one will you buy?
Just knowing that, like A and B both selling for.
What would be your answer?
Don't know.
Don't know. Correct. Don't know. So now I add another variable. I add another variable. Coffee shop A selling for 10, coffee shop B selling for 10. Coffee shop A makes 2 million a year. Coffee shop B makes 5 million a year in terms of profit. Now, which one will you buy now?
B.
B. Why?
More earning, but same price.
Same selling price, right? Okay.
Selling price.
The 5 million a year guy, coffee shop B, I put in 10 million. Within 2 years, I get back my money. Because I put in 10 million, net profit 5 million a year, second year 5 million. So I already get back my money in 2 years. Coffee shop A makes 2 million a year, selling at 10. It will take me how many years to get back?
5.
5. Longer, ma? You want to buy something that gives you money or returns your money as soon as possible, right? That is exactly the concept of price to earnings. The price is the 10 million. The earnings is the 5 million. Now, when we look at Alibaba, who do you think will be, if they're both running coffee shops, who do you think will be an equivalent Alibaba? What are the names you can think of?
Alibaba equivalent. Amazon, maybe Amazon.
Very good. Who else? Let's say in this region, who else?
In this region, Shopee.
C Limited.
Correct. C, yeah.
Okay, C Limited. So I'm going to show you my window again now. There's many ways, and I'm going to show the free way so that people can also use it. Okay, so I'm going to type in Alibaba share price. And then Alibaba share price, when you look at it under Google, you will see this thing called a PE ratio. It's given free to you by Google Finance. Okay, so what they'll do is they'll take the market cap of the company, 1.82 trillion, divided by the earnings of Alibaba for the most recent reported year, audited. So the 2023 report may not have come out yet, so they will take the 2022 numbers. Am I making sense to you? They will take the 2022 numbers. So right now the PE ratio is 40. Okay, so we look at C. Market cap 44 billion, much smaller than Alibaba. Obviously, Alibaba is a monster, but the P ratio is a dash. Now, what does it mean? It means simulator has made a loss. Cannot calculate earnings, ma. P they have, but E is negative, ma. How to calculate? Divide by negative, ma.
Oh, I see.
It's not like it's dash means it's like it's cheap or no. Okay.
Oh, it's still not updated yet.
Yeah.
I mean, if I were to look at that, I would think it's just not, the figures are not available yet.
Yeah. So you see here, also a dash. Maybe Meituan lost money. So how do we know? Beauty of ticker. We go to Meituan. Okay. You notice there's two. This is the Hong Kong exchange, and this is the Shenzhen exchange. So that's the beauty about what I like about ticker. It lists all the securities in the world. And then this one is OTC, over the counter. This is most likely in the US, or I don't know PK, what does it stand for? Yeah, but these are all the listed Meituan in all the different exchanges around the world. Okay, so let's look at Meituan Hong Kong. Okay, did they lose money? So we can plot it out again. Sales are growing. Did they have, yeah, so you see, right? Net income, the company is all in red. That means they have not had a year of profit so far. Oh, they did. 2019, 2020, they had 2 years of profit. Other than that, it's all in the red. So they have lost money. What about C Limited? Okay, we can look at the New York Stock Exchange one or the Singapore one. Oh no, this is London. Let's look at the New York one, okay? Okay. Did they make money? Losses as well. See, net income, losses. So that's why if you compare them against the other guys, right? Rather than look at the price, you actually looked at a relative valuation called a price to earnings ratio. Okay. Yeah. How fast, if you invest in this company, how fast can you make your money back? You think of it. Yeah. Yeah.
So
Do you have any
to
questions so far, Louis?
yeah, so my question is, we want the PE to be higher or lower? In this
Lower.
sense, like
The faster you get your money back.
oh, okay. So the value is like on top, right? The profit is
No, the profit is at the bottom. The price is on the top.
price is on the top, profit is at the bottom.
Yes. Denominator is the price. Denominator is the earnings.
Oh, okay, I get it. Okay, yeah. So we
Yeah.
want the figure to be smaller.
Smaller. So you
So
think
the
of a smaller figure is
cheaper.
the faster
Yeah.
you get your money back.
Okay.
Yeah. It's not exactly because obviously net profit doesn't come to you as a minority shareholder. It's still with the company, but the company can choose to pay it out to you via dividend, or they invest their money to grow the business, or that kind of thing. But we're not going to touch it. Just to keep things simple, you think about PE, yes, the 5 million, the 10 million coffee shop. The guy who gives a profit of 2 million versus the guy who gives a profit of 5 million, the 5 million guy, you will pay back your investment of 10 million in 2 years. The guy who gives 2 million in profit will pay back your investment in 5 years. So the shorter the duration, the cheaper it is, because you want to make your money back, ma. Why? If not, why you invest? Correct. Yeah.
Investors to be an owner sometimes.
Yeah. Just to short sneery. Oh, every time especially if you go to Starbucks, and they say, yeah, I'm a proud shareholder. Thank you for contributing to my net profit.
Yeah.
Yeah. It's a wonderful business though, Starbucks. Maybe we can cover that another day. Because
yeah. I think we should cover that, since Malaysians love Starbucks.
Yeah.
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 I think you've run through all the 5 questions already, right?
Correct.
So I have a few additional questions
Please come.
myself.
Okay.
So I think we know, I mean, from the analysis, if we compare Alibaba with other companies, they're big business, they're doing quite well, profitable, etc. Yet the prices have gone down, way down.
Yeah.
And we know it's only for one reason, and I think it's political. There's political influence on Alibaba. Even Jack Ma has been out of the spotlight since October 2020. And
Correct.
recently I saw the news that he actually accepted a position to be a professor a lecturer or professor in Hong Kong University.
Nice. Okay.
So he's now, I think, laying low in that sense. So my question to you is, how much of an influence does this have on the share prices? And if someone is looking at a stock, right, can they actually look at the business separate from the owner or the founder? Right now, Jack Ma is not the chairman yet. The scrutiny around Alibaba is still there. The Chinese government. When looking at a company in general, how much of an impact does it have?
I think that's a fantastic question, and I'll try to be as concise as possible, because there are many variables to look at. It's a yes and it's no. The first question is political. Is political influence a concern? And secondly, can you separate the evaluation of a business and its founder, which I consider as the term that I look for is a key man risk. Okay, I'll answer the key man risk first. Yes, it's true Jack Ma founded the company, but over time, as he institutionalized the business, he set a correct culture, hired the right people to actually run without him. I think they have kind of reached that stage. Okay, now you contrast that with a company like Tesla and SpaceX.
Right.
I feel Elon Musk is so critical as a piece of the cogwheel, because he's the guy pushing, driving, and all that kind of thing. Key man risk on a Tesla or a SpaceX is so much more critical. Even though he hired Gene Shotwell to be COO of SpaceX and all that kind of thing, I feel that is much more of a key man risk as compared to that of Alibaba today. Okay, they can still function without Jack Ma, right? Now, the earlier question about political influence is not just Alibaba. It's any Chinese company that is listed either on the Hong Kong Stock Exchange or even the US Stock Exchange. Why? You have to understand the political structure and the political belief system of the Chinese government and the Chinese as a whole. They're still very much a communist base, but with a hybrid of capitalism. Okay, they still want a lot of control, and this is where when you invest overseas, these are some of the key criteria you have to look at. Obviously, we can go on and on about political risks, structures they have, the Chinese government have in place, this thing called variable interest entity. You actually don't, when you buy a share in Alibaba, you technically don't own any equity in the company, Louis. And I wouldn't do it justice here. Yeah, it's actually a shell company incorporated in the Cayman Islands, and then when you buy the share in the US, you're actually buying the shell that is just connected through some kind of a contract. But you don't actually own equity in the company.
Interesting.
Yeah. In Malaysia, it's when you buy, you actually own equity directly in a company, in the holding company. In China's case, most of it are VIE structures. I say all of it are VIE structures actually. So is there something that you need to understand and you need to be cognizant when you buy lah? That is actually one of the main reasons that has stopped me from investing into China all this while actually.
Yeah. I think it depends on your risk appetite as well, right?
Correct.
And maybe your own views on politics in that country.
Correct.
Do you understand it well enough to predict what will come next, right?
Correct.
Okay. I think that would be the biggest question. But another key thing that happened recently was Softbank's drawdown of their shares in Alibaba. Some reports actually mentioned just 25% as being their biggest holdings, but I saw from FT is 34%. So in any case, it was a much larger chunk of Alibaba that they own, right? But now they've actually drawn down to 3.8%, right? So whenever something like this happens, right, should a potential investor be concerned?
Very good question.
I think SoftBank is what we would consider institutional investor, right? Am I right, John?
Correct.
So when a large institutional investor makes it public, like they join that anyway, it's going to be public. when they do that, what should we be thinking?
There are many facets to that. A lot of people say, oh, larger shareholders selling down and all that, right? But there's many nuances. First nuance, do they have another interesting project that they want to bank money on and they just want to cash out the profits? They probably bought it at, I don't know what is Alibaba share price today. Let me see, $89 US, if I'm not mistaken.
I think so.
Hong Kong, sorry, 87 Hong Kong dollars, okay? Yeah, they probably had it prior to IPO and their cost is maybe like $1, right? Okay.
Yes.
So what's the harm of cashing out if they made 100 times or 200 times already, or even more than that, right? Because they have found an interesting project that they want to bankroll or finance. Okay, doesn't necessarily mean. Remember, they're a incubator venture capitalist. Their mandate is to put money to grow. But if they believe that Alibaba is already run its growth rate, they also scarce on resources to pour into the new project. So they just have to withdraw. It's just the way things are. It's just the nature of things. The second thing is, it could probably also be Masayoshi needing the money himself. You never know. You never know, right? You never know. Hopefully, the press will get hold of why they really sold. Okay. Is it a concern to retail investors? I say there's only one of the variables that you should look at, rather than that being the sole decision pivoting mechanism. They say, oh, because SoftBank sold out, I shouldn't be buying. No. It's only one of the variables that you should consider. Like, most recently, TSMC was bought, quite a big chunk of TSMC was bought by Buffett. And then after that, he sold it down. I could only speculate, but I think one of it is the geopolitical risk. TSMC's business is very, very sticky. Very sticky. But I think, and I could be wrong, the geopolitical risk in Taiwan and China invading Taiwan, it's probably something of a variable that Buffett has to consider as well. So you see, there's no one fixed variable. There are many, many variables, and you have to assess each one variable in what they call it as a whole to decide whether this investment is for you. You could find a great company, great business, very cheap PE, but then it's located in Zambia or some godforsaken African country where, the numbers could be fake, the political system is in ruins, or there's a militia going to overthrow the government. How would you know that, your interests are safeguarded? Or how would you know they will uphold corporate governance of the country? That's a risk that you have to discount for. So that maybe if I see a company PE of 10 times is cheap in Malaysia because we have a relatively stable government political system, and the same nature of the business and a PE of 10 in Zambia, I wouldn't take. I would only buy when it's probably like a PE of 1 or PE of 2, It means one year I can get my money back, I run. Because you never know, things could change, huh?
Oh my gosh. Yeah, it's true. I think the idea is to look at the big picture, right? Rather than just have one deciding factor, right? I think this would be categorized under like news, right? Like, or some news moving the prices, the emotions. I mean the soft banks.
It's one of the variables that you can take into play. I wouldn't say it's news. I would say it's one of the criteria that will help you part of decision making. If Softbank sold because they have a new project to fund, or just Masayoshi just needs the money, and not because they believe Alibaba's going to taper, there's no more growth, then I think it should be cast aside or minimized. But if they are selling because Alibaba they don't see any potential growth in Alibaba. They think the government's going to come down hard on them. It's going to be more difficult for Alibaba to do business. Then it should weigh higher in your decision-making list. Am I making sense, Louis?
Yeah. I think it sounds like we need more experience. Like we need to study more companies, but I think it's a great start. And at least we know that we shouldn't consider one thing and nothing is ever fixed, right? Like
correct,
never like one or the other, but with investing, because businesses keep changing, environments, markets keep changing. So we also need to adapt and be agile when we do the analysis.
Correct. Investing, there's no binary answers on. If you're looking for binary answers, right, I think you might as well just
same with anything in life, right? Working out, eating right, relationships, no binary answers. You just have to adapt with the times. Every single things change. So I think it brings us to our last section of the podcast today. So we wrap up the analysis part. Now we want to also add a new section to this series, which is where John will recommend us a investing book. Right. So since this is a series for beginners in investing, I thought it'd be helpful for you, John, to recommend our audience and me a book about investing that you think is great for beginners to start with. So what's a must-read book for people who are just starting out in investing?
Fantastic. I recommended this book to many people. I'm very grateful for this guy called Thompson, who I met way back in 2008, 2009 in Miri, and he really opened my eyes to the right way of investing. Prior to that, I was speculating, and he spoke about this book. I've read many investing books over the years, okay, but I found this book as a great beginner guide. It's called One Up on Wall Street by Peter Lynch. Not very easy to find in Malaysia, though, to be honest. I mean, during my time, it was quite difficult. I had to buy it from Amazon. I bought in bulk, and as you can see, it's quite well stained and well used.
Sulfur oxidation is out.
Yeah, and I wrote here bought from Amazon in 2012, right? So, why should you as a beginning investor read this? Is I think few reasons. The first one is if you've never heard of Peter Lynch, he's actually compounded money. He was a fund manager at this place called Fidelity, one of the largest fund management companies in the United States. And in the 13 years he was a fund manager for this fund called Magellan, he compounded money at 29% for 13 years. Now, I just want to give you a benchmark. Currently, a lot of people know Buffett or Munger. Buffett, over the longest period of time, he compounded about, on average, 20%. In his early days, he used to compound about 40%, Louis. In the 1970s, 1960s, 1970s, when he first opened a partnership, when he was still very small, he was compounding about 40%. But in recent years, on average, probably about 20%. Peter Lynch was doing 29 for 13 years.
Wow.
Yeah. Have you heard of him before, prior to me introducing?
Peter Lynch? No.
No, okay. No. So we keep on joking, and you look at the white hair, right?
Okay.
So he's like he got a lot. He used to have black hair, but he got a lot of white hair doing this. So that's why we kind of postulated he quit because it was too stressful for him. So after 13 years. Second reason why I think you should read this book, I think it's written in very layman language. Yeah, it's not too complicated. A lot of people say, oh, you should read Buffett, you should read Buffett, you should read securities analysis. I tell you, if you read Graham's, sorry, not Buffett, Benjamin Graham, the father of value investing, right? You go to securities analysis. I've not fully read the book. It's very thick.
I have it too.
Okay.
I could do it, yeah.
Yeah, it's not an easy read. Written in 1950s, 1930s in kind of English. It's definitely not a book to start off with. I feel this is a good beginner's book. Over the years, I think I've read close to 40, 50 investing books, right? But I found this was a good starter. Written in layman language, complicated concepts are actually broken down into concise and simple case studies. This is exactly how I like it. Okay. The next reason, the third reason is actually he argues that the retail investor is actually more blessed and in a more advantageous position as compared to the fund manager. Now you'll be surprised, right? You would think, oh, fund manager, you got access to information, all that kind of thing. Don't want to spoil the surprise, but he actually argues very passionately that the retail investor is actually much more advantageous as an investor. Okay, and he actually coined few terms. The first term that I really like is this thing called a bagger. Okay, so if you buy a stock and you make multi-baggers, okay, what does it mean? I don't want to spoil the surprise as well. You go and read the book, okay. And last but not least, I think he teaches the art of retail research methods. And he's a very funny. If you read his book, right, Louis, you'll find that he's very hilarious in his writing. He comes out with terms like multi-bagger, diversification. Yeah, diversification means most businesses they diversify, right? And you think that is for the better, right? But this one is diversification. That means you diversify and you versify the business. So he's very fun, very funny actually. And then the art of retail research, he calls it kicking the tires. So when you buy a new car, right, how do you check whether the car is good or whatever? Rather than read the specs, you go and kick the tires. So he teaches you the art of kicking the tires for businesses.
That's also like something similar that what we're doing, right? Like just doing the basic, kick the tire before you check, go into too much details.
Correct. You kick the tires first. So it's like for him, right? Rather than dive very deep into building a discounted cash flow model, financial model, all that kind of thing, right? He just go and see, hey, this queue long. He actually bought he bought many consumer products companies, and he actually bought this hotel chain. In Malaysia, it's not that big, but in the US, it's quite big. It's called La Quinta.
No, never heard of it.
Okay, it competes with Holiday Inn.
Oh.
It competes with Holiday Inn, and if you, it was kicking Holiday. Pardon my French, but he was kicking Holiday Inn's arse. So it was really So yeah, he actually, rather than read like detailed analysis reports whatsoever, he went to stay in La Quinta, see whether it's good, pull the curtains. He said pull the curtains, test the tower, is it clean or not, that kind of thing. Yeah. So Yeah.
That's a very, very interesting way to go about it, right? You would think like,
Correct.
okay, you need to dig deeper, instead of
Yes.
just staying there, right?
Yes.
Mhm.
And he even like some certain consumer products, he will talk to the consumer like, why do you like this product? He never misses a chance to talk to the end user, rather than just reading. We call it reading desktop reports or doing
Mm.
desktop research. He just goes down to the ground. And he coined this term. He had many quotes, Louis. I think I do one episode of all his quotes also, though not enough. Yeah, it's so funny. If you like the store, most likely you like the business.
I think you've mentioned that before.
Yes,
Yeah,
yes,
it's
yes,
from
yes.
him. Mm.
Yeah, it's from him actually. Yeah. Lots of it lah. It's like there's another one. He says when people in a portfolio of stocks they own, let's say they have 10 stocks. The moment they have losses, let's say out of the 10 stocks, 5 lose money and 5 make money, right? When you tell them, hey, you need to change what are the components in your that one, right? Which will they likely sell? The ones that make money for them or the ones that lose money for them?
Lose money.
You sure? Actually, most
Money
people
loss.
will sell the one that make money for them because they
Okay.
said the lost one, right? They said, oh, I bought at 50 cent, now it's 10 cent, right? Yeah, one day when it come back up to 50 cent, I sell.
Oh, I see.
They try to let it come back and make hope, right? Actually, you're not like most people. I should ask you this question.
Because
Most
that's
people,
what I do. I usually sell the one that
the one
doesn't.
that lose money, right? Most people will
Yeah.
not sell the losers, but they will sell the winners. So he actually has a term for it. It's like watering the weeds and killing the flowers. So you kill the flowers, your winners. You sell you kill it,
Mm.
and then you water the weeds, hoping that the
Yeah,
weed they all
yeah.
So
Yeah, because you just focus on that part, right? Without like realizing, oh, actually, I can just focus on these.
yeah.
That's very interesting. I mean, how long did it take you to finish this book?
I read it way back. It took me probably about a week because he's very hilarious. So I really enjoyed. We're gonna do another episode on his second book. I already brought it here, but to encourage you guys to watch. Yeah, we're gonna talk about it next. But
Episode, we'll talk about
yeah,
it next episode. But
yeah.
if
But
you
this one, fantastic book.
Mm.
Took me about a week. I think you can get it in Kinokuniya and KL, or even I don't know whether I went to Popular most recently. I didn't see it there. So
Popular doesn't stock up on too many books these days. I find that they are stocking up on those like
workbooks, school
workbooks
books.
more.
Yeah,
So
yeah.
Kinokuniya will be a better bet lah. Yeah.
Yeah, Kinokuniya, or even okay, they closed down Book Depository, so your only hope is either Amazon now lah.
It's the second one mentioned. It's so sad that they closed it down. Book Depository had everything.
Yeah.
Okay. I think that wraps up our episode today. Thank you so much, John, for sharing your insights about Alibaba. I hope that the audience would find that useful. Of course, it's not an in-depth analysis. Okay, so these are questions that John asked, and it's a checklist for you just to, dip your toes and ask the right questions. Okay, instead of just looking at what's obvious, right? The price, some news here and there. You want to dig a bit deeper, and that's the idea around this series. And also, we hope that you will also, get a hold of that book and start reading. As John always says, like educating yourself, right? Investing in yourself is the best investment.
That's right. Hope to see you guys in the next episode. If you like content like this, subscribe to the channel, give it a like, hit the notification bell so that new videos are out for you. And see you guys.
See you guys. Bye-bye.